Dear students, today I'm going to take a class on portfolio management. It is a combined holding of many kinds of financial securities, shares, debentures, government bonds, units, and other financial assets. Portfolio means putting one's eggs in different baskets with varying element of risk and return. The objective of portfolio is to reduce risk by diversification and maximization of gains. The objective of portfolio is to reduce risk by selection of securities, constant shifting of portfolio in the light of varying attractiveness of the constituents of portfolio. Portfolio management means portfolio planning, selection, construction, review, and evaluation of securities. The skill in portfolio management lies in the evaluation of securities, achieving a sound balance between safety, liquidity, and profitability. Portfolio management is all about strength, weakness, opportunity, and threats. The choice of debt versus equity, domestic versus international, growth versus safety, encountered in maximum return at a given risk. A professional who manages other people's or institutions' investment portfolio with the object of profitability, growth, risk minimization is portfolio manager. He will manage investors' assets prudently and choose particular investment avenue appropriate for a particular time, aiming at maximizing a profit. Skill in portfolio lies in achieving sound balance between objective of safety, liquidity, and profitability. Investor should sell at maximum market tops and buy at market bottoms. Investors should switch from bonds to shares in a bullish market and shares to bond in a bearish market. Portfolio management is a service. One of the merchant banking activity recognized by Securities and Exchange Board of India. Objectives of portfolio management are security, safety, stability of income, capital growth, marketability, liquidity, diversification, favorable tax incentives. Portfolio management means a collection of company shares and other investments that are owned by a person or organization. A large flat container used for carrying large drawings, documents, or other papers. Portfolio is also a collection of drawings, designs, or documents that represent persons' work. Portfolio is a collection of investments that are owned by a particular person or organization. They are an investment portfolio, property portfolio. These funds are less risky because one holds a portfolio selected and monitored by a specialized manager. Now, balanced or diversified portfolio, which will lower the risk. Global portfolio. Funds are impossible to ignore if one wants a broad international portfolio. Now, bond or stock portfolio. These shares should amount to no more than 10 to 20% of stock portfolio. Product portfolio. The range of products or services that a company offers or businesses that someone owns. A company brand portfolio, about 15 complementary brands from luxury to budgetful. Strong and broad portfolio. Strong portfolio of business with an annual turnover of extremely high. Expand portfolio. He and his associates want to build up a portfolio of money making websites. Trade portfolio. The most significant changes in trade takes place. Agency portfolio that has not diversified products but supports scientific application has a balanced portfolio. Like asset portfolio, it can be incorporate bad outcomes that are relatively independent of economic well-being, such as psychological distress. Diverse portfolio. Preservation of biodiversity was seen as a way of holding diverse assets with uncertain payoffs. Diversified portfolio. There is no risk of bankruptcy because of diversified perfect portfolio of production, loans, research, financing, contracts. What is a portfolio? It is a group of financial assets such as stock, bonds, commodities, currencies, cash equivalents, as well as their fund counterparts, mutual, exchange, traded funds, closed funds. It consists of non-publicly tradable securities like real estate, art, private investments. Money market accounts make full use of this function. Portfolios are held directly by investors, managed by financial professionals and money managers. Investors should construct an investment portfolio in accordance with their risk tolerance and investing opportunities. What is the importance of portfolio? Both risk and tolerance and time horizon to be considered while choosing investment to fulfill portfolio. Understand portfolio. What is it? Investment is like a pie that is divided into pieces of varying sizes, representing variety of asset classes and type of investments to accomplish risk, return, portfolio allocation. Stocks, bonds, cash, generally considered as core building portfolios. Other potential assets include real estate, gold, currency. Impact of risk tolerance on portfolio allocation. A conservative investor might favor a portfolio with large cap value stocks, broad-based market, index funds, investment grade bonds, position in liquid, high grade cash equivalents. A risk tolerant investor and some small cap growth stocks to an aggressive large cap growth stock position. Assume some high yield bond exposure and look to real estate, international alternative investment for his portfolio. Generally, an investor should minimize exposure to securities or assets whose volatility making them uncomfortable. A portfolio, it is a basket of assets, include stock, bonds, commodities, currencies, cash equivalents, fund counterparts. Impact of time horizon on portfolio allocation. Investors should consider how long he has to invest when plan portfolio. Investors moving to a more conservative asset allocation as the goal date approaches to protect principal portfolio that has been built up to that point. Compete risk-free in virtual cash. Put your trading skills to the best with our free stock simulator. Compete with the thousands of traders. Trade your way to the top. Submit trade in virtual environment before you start risking your own money. Practice trading strategy so that when you are ready to enter real market, you have had the practice you need. Try our stock simulator today. Portfolio investment, a passive stake in asset purchased with the expectation that it will provide income, growth in value, both multi-asset class. Investing reduces risk by spreading money across stocks, bonds, and other assets. Now, target date fund. A company offers an investment that fails to grow asset over a specified period of time for a targeted goal. Portfolio is an investment trust that invests in a predefined portfolio of bonds, stocks chosen by the fund company. Granular Portfolio. It is an investment that is well diversified across a wide variety of assets, significant number of holdings over weight portfolio. It is an investment. Overweight portfolio is an investment in assets or industry sector that comprise a higher than normal percentage of portfolio or index. Most of the investors throughout their life plan for earning and spending money. Investors may have more money than they want to spend, or they want to purchase more than they afford. If an imbalance that will lead to either borrow or save to maximize the long-term benefits from their income. When current income exceeds current consumption desires, then they tend to save the excess. They use it in many ways. Put the money under mattress until some future time, or when consumption exceeds income, when they retrieve saving from the mattress and tend to have that amount they saved. They can give up the immediate possession of these savings for future larger amount of money that will be available for future consumption. This trade-off, present consumption for higher level of future consumption, is the reason for saving. This saving make them increase over time. Investment. If current income is less than current consumption desires, people borrow to make up the difference. Those who gave up possession of savings expect to receive in future a greater amount than they gave up. Who consume more than income must be willing to pay back in the future more than they borrow. The rate of exchange between future consumption and current consumption is pure rate of interest. Now, both people willingness to pay this difference for borrowed funds and their desire to receive a surplus on their savings give rise to an interest rate referred as pure time value of money. The interest rate is established in capital market either savings or borrowings, different at a given time. Now, current commitment of rupee for a period of time in order to derive future payments that will compensate investor for the time the funds are committed, or expected rate of inflation, uncertainty of payment. Now, who is an investor? An individual, a government, a pension holder, a corporation. All type of investments include investment by a corporation in plant and equipment, investment by individual in stock, bonds, commodities, real estate, investor in trading, known rupee about today for some expected future stream of payments that will be greater than current outlay. Now, an individual who purchase small amount of security for themselves as opposite to institutional investor or retail investor or a small investor. They invest to earn a return from saving due to their deferred consumption. They want a rate of return that compensate them for a time the expected rate of inflation, uncertainty of return. Today, everyone is running for money and it is considered as a role of happiness. For secured life, bright future, people start investing. They are confused of investment avenues, their risk returns, profitability. Investor to choose proper investment avenue and to create portfolio. Employment of fund with aim of getting return on it is investment. In general terms, investment means use of money to make more money. In finance, investment means the purchase of financial products or other items of value with an expectation of financial productivity in or future returns favorably. Investment of hard earned money is a crucial activity of every human being. Commitment of funds which have been saved from current consumption with the hope that some benefits will be received in future. Reward for waiting for money, saving of people are invested in assets depend on their risk and return demands. Investment is concept of deferred consumption which involves purchasing an asset, giving a loan, keeping fund in a bank account with the aim of generating future return. Investment options offering differing risk reward trade offs. An investor create a portfolio that maximize returns and minimize risk exposure. For this, there are two types of investments. Economic investment. Addition to the capital stock of society, that is, goods which are used in production of other goods. The term investment implies formation of new productive capital in the form of new constructive productivity, durable instruments such as plant machinery. Inventories and human capital are included in it. Investment means increase in building, equipment and inventory. Second, financial investment. This is an allocation of monetary resources to assets that are expected to yield some gain or return over a given period of time. An exchange of financial claims, shares, bonds, real estate, etc. Financial investment contracts written on pieces of paper like shares, debentures. People invest their funds in shares, debentures, fixed deposits, national savings certificates, life insurance policies, provident fund, etc. Investment is a commitment of fund to diversify future income in the form of interest, dividend, rent, premium, pension, benefits, and the appreciation of value of their principal capital. Traditional investments were of real varieties. Modern investments are of financial varieties. Both investments are related to each other because investment is a part of saving of individual which flow into capital market either directly or through institution. Finance decision concern with sources of money, investment decision or concern with uses or budgeting of money. Now, objective of investing is a widespread practice. Many have made their fortunes in the process. Determine characteristics of various investments, their matching with individual need and preferences. The objectives are tangible investment to buy a car, house, etc. Intangible such as social status, securities. Objectives are classified financial and personal. Financial objectives are safety, profitability, liquidity. Personal objectives are family, commitments, status, dependent, educational requirement, consumption, provision for retirement. Now, objectives are further classified as short-term high priority objectives. Investors have a high priority towards achieving it in short time. For example, buy a house. Long-term high priority. They look forward investing long-term needs like post-retirement investments, education of child, marriage, etc. Low priority objective. They are not painful. After investing high priority assets, they invest in low priority like tours, domestic appliances. Money making objectives. Put surplus money in maximizing wealth. Invest in shares, coupons that provide capital appreciation apart from dividend. Now, what is the importance? Lifestyle. They ensure other assets that can meet their financial needs over a lifetime. Financial security. Protect their financial needs against the risk. Returns. Investors want a balance of risk and return suitable to their personal risk preference. Value for money. Investor wants to minimize cost of managing their assets and financial needs. Peace of mind. They don't want to worry about day-to-day movement of the markets and their present future financial securities. The investor having all their assets and needs managed centrally with portfolio plan to meet lifetime needs with one overall investment strategy ensuring that disposition of assets will match individual needs and risk preferences. Investment speculation. Speculation is an activity a person assures high risk often without regard for safety of their invested principal to achieve large capital gains. Time span is usually short. A speculator does not buy goods for himself but to sell them later. He wants profit from changes in market prices. One tries to buy goods when cheap to sell them when expensive. Speculation means buying, holding, selling. Short time of stocks, bonds, commodities, currencies, real estate, derivatives, valuable financial investments. One wants to use them for daily life or to get income from others. If not purely gambling, speculation do make informed decisions before choosing to acquire additional risk higher than average. Most of them use hedging strategy with speculative investment in order to limit potential losses. On the other hand, investment means putting money into asset which is not necessarily marketable in order to enjoy series of returns. Investors sacrifice money today in anticipation of return in future. He indulges in a bit of speculation. These decisions are not carefully throughout, just based on tips and rumors. Now, what are the elements of investment? Return, risk, time, liquidity, tax saving. So, what are the attributes? Every investor has certain specific attributes through long term, short term investment to achieve monetary and financial objectives, safety, security, or of the fund investors. Liquidity, convertibility into cash as and when required. Personal objective is every investor suitable avenue for investment. So provision for old age, sickness, and provision for house, construction, provision for education, marriage, etc. Now, period of investment. It may be short term up to 1 year, or it may be 1 to 3 years, or even long periods. So, risk in investment is it needs a careful consideration while selecting the avenue or investment. Normal feature of every investor, he has to part with the money, hard earned money, immediately and collect it back with some benefit in due course. More or less risk carried in avenue. Risk is the liquidity, inflation, market, business, political, and other risks. Thank you.